Most real estate investors are leaving tens of thousands of dollars on the table just because they don't have this playbook. Today, I'm going to show you the essential tax guide to real estate. Hey everyone, I'm Gabe Velez, CPA and partner at Terrani & Velez, where we specialize in tax and accounting for business owners and real estate investors. Today, we're walking through the 6 essential steps you need to take as soon as you acquire a rental property. Our agenda includes identifying land value, conducting a cost segregation study, creating a depreciation and disposition strategy, setting up proper bookkeeping, determining the level of activity and its implications. Finally, we'll touch on how to access your property's equity and even introduce some advanced tax strategies. The steps are on the slide, so let's get into it. Step 1, identify the land value. The first thing you need to do when acquiring a rental property is allocate the purchase price between the land and its improvements. Why? Because land doesn't depreciate, only the improvements do. That means the portion allocated to land won't generate any tax deductions until you sell the property. Most tax preparers default to the county's assessor's office land to building ratio. While this is really convenient, this isn't always the most accurate because the assessor is focused on property tax assessments, not fair market value. If the allocation seems off, especially if the land value is overvalued, we recommend hiring a qualified appraiser. A good appraisal is going to help you maximize depreciation by allocating more value to the improvements. It also helps create a defensible position in the case of an audit and avoids overstating the land value and losing out on deductions. Now keep in mind, every purchase involving a bank requires an appraisal take place. However, the appraisal will not break out the land unless you specifically request it. The more value assigned to the building, the more you can depreciate. And that means more tax savings in early years when your dollar is worth more. And that's better than later years when it loses value to inflation. Step 2, conduct a cost segregation study. Once you've isolated the building value, most preparers apply the default depreciation schedules of 27.5 years for residential properties or 39 years for non-residential property. And they apply it to the entire value. But here's the problem. That spreads your tax benefits over decades. With a cost segregation study, we apply accelerated depreciation by breaking down the building into its components. Instead of one big 27.5-year building, we identify things like 5-year property, that's appliances, carpets, blinds, etc., or 15-year property like sidewalks, fences, driveways, landscaping. A typical study reallocates 10 to 25%, sometimes even more, into these shorter recovery periods. That means bigger deductions in the early years, immediate cash flow boost, and strategic flexibility for future renovations or dispositions. Here's a pro tip. Cost seg studies can be especially powerful when paired with bonus depreciation, and we'll get into that next. Step 3, depreciation and disposition strategy. Once the cost seg is done, you now have the data to make key tax decisions. First, electing bonus depreciation. For assets with a life of 20 years or less, like that 5 and 15-year property that we talked about previously, you can elect bonus depreciation. And in 2025, this allows you to expense 40% of the assets immediately. Assets placed in service between September 27th, 2017 and January 1st, 2023 enjoyed 100% bonus depreciation, and currently there are talks about making it 100% again. This is huge, especially in high income years when you want to offset more tax. Second, your partial disposition strategy. What does that mean? If you replace a component like a roof, HVAC, or flooring, and you had previously done a cost seg study, you can write off the remaining value of the component you're putting in the trash. For example, let's say for easy math that your roof was valued at $27,500 in your cost seg study. After 10 years, you've depreciated $10,000. You now replace that roof completely and remove the old one. You get to deduct the remaining $17,500 immediately as a partial disposition. And then when you place in service the new roof, you get to depreciate it. Bonus tip, the look back study. What if you missed steps 1 through 3 when you first bought the property? You can still recover those deductions through a look back cost segregation study and an accounting method change. Here's how it works. Number 1, get a qualified appraisal to retroactively assign land versus building value. Number 2, perform a cost segregation study even years after the purchase. Number 3, elect bonus depreciation where eligible. And then number 4, file Form 3115 to report a change in accounting method. The result, you get to take all of the missed depreciation as a catch-up deduction under IRC 481A in the current year. This often means tens, if not hundreds of thousands of dollars. Just remember, bonus depreciation rules follow the year that the property was placed in service, not the year of the study. So you apply the old rules. Step 4, bookkeeping. Great tax planning starts with great bookkeeping. Most investors rely on property managers, and while that does provide monthly cash flow statements, that's only one part of the picture. Here are the things your tax preparer needs. The property management statement, rents collected, repairs paid. Mortgage interest payments, typically found on Form 1098 MIS. Real estate taxes paid. Property insurance. Expenses you paid personally outside of the property manager. Also, keep detailed records of capital improvements like new HVAC systems, roofs, or kitchen remodels. These aren't deductible in full, they're depreciated. And make sure to distinguish repairs, which are ordinary and fix existing issues and are deductible in the current year. Also, there's a de minimis rule that, if elected on the tax return, allows you to deduct anything under $2,500. Improvements extend the useful life or replace major components of the property. This adds value and is capitalized and depreciated. If you're unsure, lean on your tax strategist. Misclassifying expenses can leave deductions on the table or create audit risk. Step 5, participation level. This one's big, and it's decided annually. By default, rental real estate is a passive activity, and passive losses can only offset passive income. But with strategic planning, you can elevate the status and unlock those losses to offset any income. Option 1, the real estate professional status, or REPS for short. To qualify, you or your spouse spend more than 750 hours in real estate and more time in real estate than any other activity that requires your personal time. This is ideal for full-time investors or if your spouse manages your properties full-time. REPS allows rental losses to offset W-2 or business income, but be warned, if the person claiming to be a real estate professional also has a full-time W-2 job, the IRS will scrutinize that and likely disallow it. Option number 2, the short-term rental strategy. Short-term rentals can be treated as businesses, not rentals, if the average guest stay is 7 days or fewer and you materially participate. For example, spend 500 hours annually. If the average guest stay is longer than 7 days, it might still be a business, but only if there are substantial personal services being rendered. Think rehab facilities, nursing homes, boarding schools, etc. If so, losses from the STR can offset W-2 or business income without qualifying as a real estate professional. This strategy is popular with Airbnb operators and active hosts. Step 6, advanced tax strategies. The previous strategies were all ways to mitigate taxes on income from your rental property. Now let's take a brief look at how you can access the appreciation of your property without triggering huge tax bills. Again, this is just a brief overview to give you some ideas because each of these strategies could be its own presentation. Number one, refinance to access the equity by following the Burr method of buy, rehab, rent, refinance, and repeat. When your property appreciates, you can refinance and pull out the cash. That cash is not taxable because it's debt, not income. Number two, the qualified opportunity zone. Sell an asset with capital gains. You can defer or potentially eliminate those gains by reinvesting them in a qualified opportunity fund. Rules change depending on timing, so make sure to get the details before you commit. Number three, the 1031 exchange or like-kind exchange. Sell one investment property and defer that gain by rolling proceeds into a replacement property that's like-kind, that is of greater or equal value. If the replacement is of lesser value, you can still defer some of the tax, but the difference is called boot and in fact will be taxable. In fact, any money coming out of the relinquished property could be construed as boot, so don't refinance a property right before you're going to sell it. Refinancing the replacement property after the purchase is generally safe. To be safe, use the 2-year safe harbor rule. The property must be held for investment use for 2 years before and 2 years after the exchange, so the IRS can't challenge your position. Number four, the primary residence exclusion. If a property was your primary residence for 2 out of the last 5 years, you can exclude up to $250K or $500K if you're married. Number five, indirect tax planning. Coordinate your real estate strategies with other strategies like losses from businesses or carryovers or capital losses. Any of these strategies, and the list goes on, can be combined with your real estate in order to have a good outcome. Number six, estate planning. Follow a swap until you drop strategy. That is, kick the can until you kick the bucket. If your heirs inherit capital property, they get a step up in basis, meaning they are treated as if, for tax purposes, they purchased the property at fair market value on the date of your death. And then they can sell it a day later with zero capital gains. Proper estate planning means your real estate legacy lives on. Today's presentation was focused on asset level and activity level planning, how to recover your investment costs, and how to strategically manage depreciation and classification decisions based on how your property interacts with the rest of your tax picture. Here's how everything we discussed today fits into the broader framework. Asset level planning. Recover the cost of your investment quickly with accelerated depreciation, cost segregation studies, partial dispositions, and proper classification of repairs versus improvements. Activity level planning. Determine the level of participation in the rental and how that plays into your broader tax plan. Entity level planning. We didn't cover this today, but it involves optimizing your ownership structure, LLCs, partnerships, S-corps, for liability protection and tax efficiency. Now, most investors go with LLCs. The reason why is outside of the scope of today's discussion. Exit planning. Access equity tax efficiently through refinancing, 1031 exchanges, opportunity zones, or estate strategies. Thanks for joining me today. For more tax strategies or to build your comprehensive tax plan, head over to www.tnvllp.com/tax-planning. That's www.tandvllp.com/tax-planning. I'll see you next time.